Welcome to the LA County Real Estate Investors Association weekly podcast on how to get started or advance your real estate investing business. Really excited to have today from Engineered Capital, Sandhya Seshradi. I know I butchered that. I've talked to her 3 or 4 times. We've done a couple recordings. She's been a great guest on this call before. She's been a great guest on a multifamily call before. But more than all that, she's really a master investor and I think teacher for people looking to progress in their real estate career. So Sandhya, thank you so much for joining us today.
Thank you so much, Bill, for having me again. I really appreciate it. And I appreciate your flexibility in rescheduling.
And then just some bookkeeping. You're located in the Houston area?
Dallas, Texas. All my
Close.
deals are in Dallas.
Sorry about that. Wrong football team.
No problem. It's, I'm a big Dallas Cowboys fan, and don't hold that against me, but I actually like to paint my buildings in those colors.
Get out of here. Really?
Yeah, navy blue, gray, white. If I get a chance to exterior paint them, it's going to be loosely following those colors.
That's a different level. I'm rooting for the Cowboys. I get if you're in Texas, you kind of have to, but to paint the colors, that's really something. And so, okay, well, we'll hopefully you'll do better with your investments in the Cowboys probably for their football team. My favorite coach of all time was Jimmy Johnson when he was in Miami. I actually met him, and they went to Dallas and of course won some Super Bowls with the Cowboys. So talk a little bit about how you got started in real estate. I mean, did you grow up as a child saying, I want to be a real estate investor, or how did you get into the business?
I never thought I would be in real estate like most Asian geeks. I was strong in math. And so I got an engineering degree and I actually had a W-2 in engineering. And I also learned business by going to evening and weekend classes to get an MBA because all the business sales and marketing types were telling us, the geeks, to do this and that. They were choosing the projects and I wanted to learn that. That's where I also learned to trade stocks. I learned financial analysis and things like that. So that degree was very helpful, got me a good network. But years later, I always wanted to have something to do with real estate, but I was afraid of doing fix and flips and single family rentals because I didn't grow up with a handy person's background. So it was hard for me to imagine, what it was like to have to fix a leaky toilet on Thanksgiving Day. Right. And the other part about single family was that, if one unit doesn't rent, my income goes from 100% to zero. So I attended a weekend event where they talked about large scale multifamily, which, is buildings that cost you $10, $15, $20 million, which is money you and I typically don't have. And so
let me check my pocket real quick. Let me see if I have 10, 15 million. No, I don't have it. You're right.
Right. Remove some of those zeros and I might have it, but not with that many zeros.
I got $20 in my pocket.
That's where it involved, raising capital from other people. And so that's a bigger business to get into. It's a syndication business where you use other people's money. They come in just like, the passengers in a plane is the analogy I use. So they come in, they invest, and then they sit back and enjoy the ride while you have 2 or 3 people as the main pilots of the plane, right? And that's like the general partnership. So I also started as a passenger, which is a limited partner or passive investor. I used my retirement money from my past career. I had quit my W-2 once I had children. And so I had that retirement money left. So I transferred it to an IRA, a self-directed IRA, with which I was able to invest passively. And then I got on the active side where I'm the one, behind the steering wheel, if you will, to manage these properties, to underwrite them, to make offers, etc. So that's what I do now. I've lived in Dallas 33 years. So This is my market. This is the place I know. Give me an address and I'll say yes or no. I don't even have to analyze it. I know this market so well. I know my little buy box so well.
So 33 years ago, so you started when you were 10 years old. Very impressive.
Of course.
So let's go back up a little bit to where you started as passive investor, which as the term you use, I think is a good one, is a passenger. Did you start with the intention of getting into syndication, or did you start with the idea of I'm going to learn along the way and see how it happens, or was it just fate that drew you from being a passive investor to raising funds and building your own projects?
I always knew I wanted to get on the active side, but when it involves other people's money, I wanted to do it more slowly. So let's say I'm interested in, oil and gas or RV parks or some other asset class. I would go about it by doing passive first for at least a couple of deals, understanding the process before I go active. And then even that is, I look at it as my education phase, which is passive, then the intern phase, which is partnering with somebody with more experience, and then the lead, which is on my own. So passenger, co-pilot, and pilot.
And I give that same advice from a career point of view. When people tell me they want to get into real estate, I always say, get any job you can at a real estate company. And now you're getting paid even minimum wage is better than paying for tuition
Right.
while you're learning real world business. And so in your
Yep.
case, you took your retirement that was probably in some overpriced mutual fund and getting killed
Yep.
on the fees to, even if you lost, that's when I started investing in real estate, even if I lost half of it, if I learned, it was worth a fortune. And I think that's where you leverage yourself, is if you're learning along the way. And so I think it's a great way to start passive. So what does a passive, let's go back to the beginning. For somebody who's newer, and you mentioned a self-directed IRA, which there are different options to do that. What's a passive investment for an initial real estate investor look like?
So usually our minimums are $50,000 to get into a deal. So we're buying this apartment complex, let's say for $20 million. I need to raise somewhere between $8 and $10 million from investors. So I cannot take $5,000 investors. But what I've seen people do is, if that $50,000 itself is a large amount for them, typically there's 2 or 3 of them, family members or friends, who combine and form an LLC. And then their LLC will write that $50K check to invest in this deal. So I've seen people do it that way, but my average investment is between 100 and 200,000 from my investors. And together that adds up to, the 7, 8, 9, $10 million that we need to do as the down payment in the acquisition of a large multifamily.
And when you say down payment, you also mean there's closing costs, and there's probably maybe some improvement money set aside.
Correct.
And some reserves set aside.
Correct.
And so on. So you talk about the entire project has a certain amount of funding requirement that you've laid out, hopefully on a piece of paper, and people look at that before they write a check.
Oh, big time. We have a whole webinar. We show them the underwriting and all of that. The biggest thing to remember in all of these underwritings is the assumptions. How do you know you're going to get that much in rent? How do you know you can charge, 25 or 50 for parking and somebody's going to pay it? So that's where really your vetting comes into play, is, do they have experience in that market, or do they just start, pull up some numbers out of a hat and put it in that spreadsheet? So you want to know if these folks have prior experience in that local market, because insurance and taxes, if you don't estimate them correctly, especially in Texas, that's going to kill your deal.
So the initial starting point for this is investing either as a passive investment of your own, a $50,000 minimum, which is common. I've seen some 25, but mostly 50, which could be you and several friends or family if you put together and bring it to the sponsor as a packaged LLC. What are they getting for $50,000? You're getting $50,000 of the $20 million project, right? So what does that mean you get? You get income guaranteed, you get income as it comes in. What's the return that a $50,000 limited partner investment would expect to get, and what do they have as security?
So there's no guarantees. You can lose all of your money. Just like with any stock market, there's a big prospectus for a mutual fund that most of us don't read, but it tells you that you could lose all your money and you can't go back and sue the mutual fund manager or the general partner. But the biggest thing to remember is this is like a private placement memorandum. You'll read a lot of fine print before you sign it. And yes, you could lose all your money. So you want to minimize your risk. There are no guarantees, but there are projections. This is what we project the deal to do. And that could change in, 6 months if the Fed does something with the interest rates that increases the interest rate, and the floating rate bridge loans, the interest rate goes up. That could affect it. So you want to know what kind of loan they have. What are the risks? What are the things that could go wrong in a deal? And what are they doing to mitigate that risk? And if they're already running and managing similar properties in the same location, as you know, real estate is big on location. So if they know how to manage properties in, Long Beach in California, that's very different from managing properties in Texas. So you really have to be very local, have that local market knowledge, and see what it takes to minimize the risk. But in terms of projections on a typical deals I have done in the past, we say that in anywhere from 5 to 7 years, we think we will double your money. And a lot of it is dependent on the cash flow. So the cash flow in the past used to be 7 or 8%. Now it may be closer to 5% annual cash flow. And then a lot of the upside comes at the time of the sale. Like, as you know, in California, house prices go up significantly, but you may not necessarily get cash flow because that tenant may not pay, etc. Right? There's a lot of challenges that happen. There could be repairs that are unexpected, etc. So the cash flow is not really consistent and steady, like putting a CD in your bank. But what you're betting on is the upside that hopefully happens, because this is a growing market and a great location and a strong team operating the deal. So in that 5 to 7 year time frame, it could be 1.5, 1.7, 2x, etc. And that varies by deal. deal by deal.
Now, to be a little precise, or to put some fine point on your transactions, there's no guarantee return. Now, there are other providers who offer a guarantee rate, right? Maybe preferred loans or other methods. But at the same time, there are those investors who offer a guaranteed rate that can't meet that guaranteed rate and have problems. And famously in California, we have a big investor, Blackstreet, not BlackRock, but Blackstreet, who guaranteed our state 11.25% interest when they signed the contract 2 years ago, and they're behind $500 million. So even giant companies can offer guarantees. The guarantee is only as good as the cash flow, because at the end of the day, if the money's not there, the money's not there. Nobody's going to dig money out of their pocket to give it to you because they're honorable, right? We see that in the marketplace.
I would read the fine print of any document you sign to see if it is guaranteed, because some investments offer what is called a preferred return.
Right.
That is not a guarantee. Even a preferred return is usually a second or third lien position. So on the equity stack, the first money always goes to the main primary lender. They are the ones who have the first position on the loan. Then they could be a private equity company writing a fat check, like $1 million check or something. So they could be above in that equity stack. And then finally, what we call the limited partners. And so the limited partner gets paid last after the main primary lender, bridge lender, Fannie, Freddie, whoever that is, private equity stack, and then the limited partner. So even on a case of pref return, some deals might offer you a preferred return of 8 or 10%. But if the deal in the first year, because of its value add component, only makes 3 or 4%, all that it means is you get the 3 or 4%, and the sponsors, the general partners, don't take any money for themselves until they catch you up to that 8%. So that could very well be at the time of sale. So the first thing they do, they pay off the loan, they pay off the private equity, and then they pay you up to your 8%. And then what is left over, they will split it as, 80, 20, 70, 30, whatever that ratio or split is. So even in the case of a preferred return, when it comes to real estate syndications, there are no guarantees. So I would encourage you to read that fine print very closely.
So one of the components so limited partners now are into a deal, and they're going to get some sort of return. In your transactions, do you pay quarterly or monthly or annually? How do you typically, assuming everything goes well, how do you typically pay limited partners returns on their money? They get it only when you exit, or is it paid along the way as well, or both?
We pay quarterly, and every deal we will tell you that because it could vary deal to deal. But so far, we have consistently paid on a quarterly basis is how we have paid. So on my deals, which have been, completed a full cycle, meaning I bought it, I did my value add, and then I sold it, and everybody got their money back. My first deal did extremely well. We paid every quarter, even through COVID. We acquired it in 2019. We sold it in 2021, and interest rates were climbing down at that time instead of going up. And so that really worked in our favor. We tripled people's money. I can't do that for you now. So we did not project it to triple people's money. In fact, we said in 5 years, you'll get 1.7x. And we ended up in 2 years and 3 months doing a triple, 3 times the return. So that was crazy, right? That was part of it, was the timing of interest rates coming down.
That was great. That was fantastic.
I know. I wish I could have put more money in my own deal at that time, but I didn't know. So
we all know that. If we all knew how long it would last, we would put all our chips in and roll it. But
right. And bought a bunch of properties when the interest rates were 2.5% instead of now,
Right. One of the things that you mentioned in passing that I think is really important, I know I value that, is having a team that's local with multiple projects. That's one of my criteria when I invest as a limited partner, in that it's really easy to put a spreadsheet together and talk about how much money you're going to raise and how you're going to turn over the tenants, you replace tenants with better tenants. It's much harder to do it, right? In any business, it's not the goal setting, it's the execution of every day doing the things you're supposed to do. So talk about your team in the Dallas metro area. How many different people do you have? What does it look like overall? And as you add a new project, do you scale up right away to fill the new project, or do you borrow from people, or how do you manage that process?
So we always raise money through the syndication model to close the deal, right? So we decide what loan product is best. We work with our lender brokers or the direct lender, and we have the term sheet figured out. We have all of the rents, etc., from a budget provided by a local property management company that we hire to manage the property. So there is on-site staff, there's a maintenance person, at least 1 or 2, depending on the size of the property, leasing manager, and property manager. They run the property. So we hire a property management company. We have a budget put together. This is what we present to investors as our underwriting. And then you go through the closing process. We have a syndication attorney who draws up all these documents that you can look over before you sign it as a limited partner. Once the deal closes, now I have so to call the keys of the kingdom.
Here's your keys. Good luck.
Here's my keys. Here's your day one. We have a business plan that we will execute. And the first phase of that is always the lender required repairs, whatever we need from the city for a certificate of occupancy, any tenant work orders, any leaks, any things that need to be fixed immediately, any other immediate repairs, deferred maintenance, and then the actual business plan. Hey, let's go paint this building, or let's go do new signage, or let's go update the interiors, etc. So that is our typical process. And as far as my general partnership team goes, I usually have at least one or two other partners, just so that if I get hit by a bus, you know who else to call. And you have all of that information available to you right from the beginning of the webinar onto the investor portal where you are signing the documents. So you have a secure portal, just like when you buy stocks, you have your E-Trade portal, right? Where you log in and you know how many stocks you have and all of that. Just like that, we have a secure portal. That's where you will receive your tax document, your invested amount, all of that.
It's funny you say that because I invested in a project with a friend of mine as limited partners separately. We just did it on our own. But the same project, same as you, we met them on the multifamily call and started a relationship. And she couldn't find there was a contact person like you who brought us into the organization. But I took the trouble to meet the other people in the company. So I met the president, I met in your case it's you, but I met the president, I met 2 or 3 other management people. I'm a networker. I don't know. Before I write a check, I went to who I'm dealing with. She called me, my friend called me to panic. Oh my gosh, I can't get hold of X. Yeah, well, why don't you just call Joe? Like he takes my phone call when I have a question. So it's one of those things where you need to take, I think that you probably put more time into presenting the materials, unfortunately, than investors take in reading the materials. And I try to tell new investors, part of the process is learning the skill of learning, right? Reading the financials, understanding them, asking questions. Sometimes I just look for questions to ask just to hear the answer. How do they respond? Are they defensive? Are they, yeah, you're right. We did have a bad month here.
Yeah.
But here's what we did. Here's what we did to solve it. Or we lost our entire, property management team. We had to replace them midstream, and that's what happened. So I do think it's important to read these things to learn and build a relationship, especially in the beginning of your career, because it takes some of the magic away from it, takes some of the uncertainty away from it.
Yeah, I agree with you. And in our case, the webinar slides, the webinar deck, all of that is part of the material that is stored in the investor portal. So even if you forget what we presented today, 2 years into the investment, you can still log into that same investor portal. You can look at the monthly reports for the last 24 months. You can look at what was initially projected. Everything.
And compare. Initially projected this, you said it was going to be this, and it's that, and ask the question.
It's a projection. That's the biggest thing you have to remember is none of it is written in stone. I could say something today, and in 2 weeks, the Fed can change interest rates, the economy can be down, expenses could go up, my insurance could double, taxes can go up. So it really is a snapshot that's valid on the day the webinar is presented. It is not a promise. It is not a guarantee. Everything is uncertain, and you need to be comfortable with that and understand that your money is illiquid. This is real estate. You have to buy real estate and wait. So if you bought a single family home, you got to wait a little while for it to appreciate in value. And you may not get rent for a couple of months because you had to do repairs. So what little $200-300 you made after paying for all your expenses may be gone to pay for those repairs. It's just like that on a larger scale. So when there is net cash and there's final cash flow after repairs and mortgage and everything else, well, then you get some cash flow. Sometimes you may not get that cash flow. And you got to wait 5-6 years for that value of that property to appreciate. It's not a flip. It's not going to happen overnight. So you got to remember that.
Right. And that's the nature of that type of investment, right? There's different investments, fix and flips, wholesale that are quick kills and make money right away, and other ones that take longer, and you have to find the right fit on the menu for you. So I believe you are exclusively, at least your organization where you're syndicating is exclusively multifamily or apartment investments, right?
Yeah.
Do you do value add, or is it just more about cleanup, paint, and more cosmetic, or do you actually look at a project and maybe either add units or add amenities and try to really dramatically change the value by adding value to it?
We still prefer to buy stabilized properties, meaning they're already close to a 90% occupancy. They qualify for Fannie and Freddie kind of loans. And so we don't take ones that are, having 20% down units or only 50% occupancy and do deep value adds. We do more of a light value add and some level of value add. The biggest thing is I try to find the bargains, which is properties where the rents are far below market because they've been long held by the same owner for a while. So right there, I have a basic organic rent growth walking into that property rather than buying the one that's at top of the market, the white elephant on the street, if you will. And so I avoid those. So that's why, I search for a very specific little box in my criteria that I go after. The phenomenal location is important, low crime is important. But in terms of value add, yes, we usually do interior upgrades because people like nicer things. So we like to buy properties that are very classic, look like something in the old 80s. And then we come in and put the, nice countertops and stainless steel appliances or new floors, etc. People love it. We do add to the amenities. In some cases, we've added like a playground or a dog park and things like that. But we don't try to completely revamp the property.
Right. Interesting. Okay, good. And I think the thing that investors need to understand is every syndicator has kind of their flavor, and you have to kind of buy that version of the market. I actually like your version of the market personally. So I think that big value adds always requires big assumptions, right? If you say to me, well, we're going to add another X number of units, and we're going to dramatically upgrade the facility, and we're going to fence it and make it go from a C class to an A class property. You're assuming all that's going to get absorbed. The more you change, the more assumptions you make. Versus, I kind of like the light approach. Let's talk a little bit about interest rates and the changes. Now, if you're doing light improvements, I imagine, aren't as well. Let me ask you: you mentioned like Fannie Mae loans? Are you buying the property with a Fannie Mae loan? Or are you buying it with a bridge loan and doing your improvements and then planning to refinance? How are you managing the financing and then the risk of those interest rates?
So since March in 2022, I got one deal that was a bridge loan only because we were buying it from the original seller's son, and he had done everything as a handwritten, self-managed notebook style of accounting and everything. And so Fannie and Freddie really want a professionally managed company to manage it for a while and have, those kind of reports before they'll take you on. So that was a bridge loan. But then I did two other deals in 2022 for which we got actually fixed rate Freddie loans because we knew interest rates were going to go up. They started in 2022. We didn't want to take that chance. And so our investors did not have an appetite for floating rate loans. So that's why we wanted to get a steady fixed rate loan. So no matter what the Fed did, right? I have two deals locked in at 4.5% and 4.7% interest rate. So and today, it's closer to 7 or 8% interest rate. It doesn't matter. It doesn't affect my mortgage payment on those deals. So I've done both.
Because you're buying the property knowing it's going to be 7 or 8%, and either cash flows at that or it doesn't. If it doesn't, you're not going to buy it. And if it does, you're going to buy it. And I think that's the difference. And so I think to people listening, there's really kind of three different stages. There's the value add where they're going to do something for a while, but that while typically they can't finance the properties with long-term financing. And so there's a risk. Now there are risk mitigation techniques. There's interest rate caps and things like that. Not so simple and not, number one. Number two would be what Sandhya's doing, which is more of a buying it ready to go and maybe improving along the way to improve the yields. And then there's ready to go properties that are already at the top of the game. They're going to have lesser yield. And so you have to find the right appetite and the mix between the interest rates and the risks for you. Let's talk a bit about the Dallas market. I mean, I know Dallas pretty well. I've done business there. I used to work for Centex Homes.
Nice.
Full disclosure, I went to a Dallas Cowboys LA Raiders game and we beat them, and I was pretty rude to the Texas fans while I was there. But that said, I know the market well. What is it about the Dallas market? You obviously live there, but I imagine you could choose to live elsewhere. You have family. I'm sure that kind of limits your choices. But why Dallas, and what makes it an attractive place to do business for you?
The biggest thing is the macro and microeconomics. So you've got the job growth, the population growth, all the migration is towards Dallas. More and more businesses are settling in Texas. We have a wide variety of jobs. So like I bought two properties in Irving, And, Wells Fargo was setting up one of their sort of not the main headquarters, but a second kind of big center right there within a mile of my property.
Wow.
There was a Four Seasons hotel there that went through a $65 million rebranding as a Ritz-Carlton. And that's where all the golf tournaments are held. That's, again, 2 miles from my property. We have a wide variety of industries from, food manufacturing to banks and real estate to technology. So the big semiconductor explosion that happened, you're seeing some of that in Phoenix, but there's also this area called Sherman, which is north. I worked for Texas Instruments, a semiconductor company, so I know all about that business, and that's headquartered in Dallas, but you also got Trike, you got other semiconductor companies coming there for manufacturing. So, and then the telecom corridor is not far from where I live as well, and there's a ton of high-tech and telecom companies, your Cisco's, et cetera, established there. So it's the wide variety of industries and jobs. So for every, white collar job, you need a certain number of blue collar jobs. And so I can see it. And I've seen the explosive growth that Dallas has done in the last 3 decades. I've actually watched it. That's big. The second piece is that the crime. I always look for low crime areas because then I drive my properties by day and by night. That helps me. And the third part is just familiarity with the location helps me, therefore, really identify those nice little pockets where things are safe. And I can visit my properties anytime I want. So today, in one day, in half a day, actually, I could visit 5 different properties. And that convenience can't be beat. So I'm a very hands-on asset manager. I'm the local boots on the ground. So no matter what property management tells me, I do a trust but verify model. So I can just drive by and say, did the contractor really show up? Did this really get done? I have an app with cameras, so I can still verify a lot of things on the app. But more than that, the personal visits, the connection with my on-site staff, taking them a little, Chick-fil-A lunch, which is big for us here, et cetera, kind of things, build that rapport. And that's important to me. I would have considered Houston, except that the insurance costs are crazy. There are floodplains, et cetera. And it's still a 5-hour drive for me. I don't try to do smaller secondary and tertiary markets only because it's hard to get vendors there. You don't have competitive pricing and bidding. People have to have a day's worth of work to even drive out there, et cetera. So, there's markets like, I don't know, Midland, Odessa has only one, industry there, right? And Tyler, Texas, et cetera. So Dallas is a big metro. That's why I like it. And it's landlord friendly, right? Fundamentally, it's not like California where a renter could stay for 2 years. My sister has some single family rentals there. She's had renters who haven't paid her in like a year. And the reason she's able to withstand it is because your prices go up enough so that when they move out, she can sell the property and make some money from it, but not me, right? So I need that cash flow. I need the properties to sustain themselves and pay the bills because I take other people's money.
Just for the record, I used to go to Midland, Odessa, Texas. There was a Texas Instruments plant in the middle between the two, and there was the airport, and then there was the hotel, and then there was the plant. There was nothing else within like 50 miles. Midland one way, Odessa the other way. So
a very, very long time ago.
It was a long time ago because since then everything's filled in and it's a big market. So let's talk about the multifamily market and where you see that headed 2024. Obviously, specifically in the Dallas market. I mean, I read online about markets that got overbuilt, that there's more product coming in than being absorbed, that had tremendous growth and are seeing retraction or maybe adjustments or corrections. Do you see that in the Dallas market now, or do you feel like you have your inventory is right sized and you're able to still navigate through that?
I mean, it's just like you walk into like a Nordstrom and you'll say everything there is expensive. But you can go to the right rack and know your prices and find that deal, right? It's sort of like that. In general, there's a lot of oversupply. So it's going to affect, if you have a brand new building getting built, next door to it, if you have also an A class, which is something built in the last 5 to 10 years, that might be affected a little bit by the supply. But I buy C and B class, which is more workforce housing. So median income of, 50, 60, 70K kind of people for their entire family. So I haven't seen a need to decrease my rents yet. My rent growth is exactly what I had underwritten for 3 or 4 years ago. So as a deal that I acquired in 2021, for example, my biggest rent growth is always going to be that first year. And after that, it's going to taper off to 2 or 3%. Now, sometimes in the lean season, like if I have some renewals coming up in December, I've had to waive an admin fee or application fee to get them, filled. But I haven't had to reduce my rents yet. So again, it's a matter of finding those bargains. Like I said, you got to find those deals that are, rare, but they're the right bargains for the quality you want in an A-class location, but maybe it's only a B or C-class property.
And so when you're re-renting a property, you typically upgrading it and then re-renting it, or you typically re-renting it, getting an increase on that price?
So we do 2 phases of it. So the first initial phase is what I call the basic upgrade, which is, a basic make-ready paint and things like that, but not all the fancy all the way. So I like to do it in 2 phases because I don't know if this new renter is going to treat my unit well. So I want to do just a basic organic rent growth. And then the second phase, after they leave or they're really good tenants, then I want to upgrade them to the full level of, okay, it's stainless steel appliances is what I call the platinum upgrade. So we don't go from 0 to platinum. We do it in 2 steps. We want to get a pulse for the deal first, the first 6 months. We don't want to spend $20,000 on an upgrade and realize that we're only getting a $200 rent bump. So I always look at my ROI and payback period in every one of these capital projects. Wow. And so a basic make ready first, rent it for some time, get a pulse for the property, see other deferred maintenance issues you come across as you live and breathe the property through the summers and the winters. And then you do it in a second phase. Typically after a year is when we do more fancy and platinum upgrades, if you will.
One question I get asked a lot, when I see people who are not in real estate.
I can't hear you.
Sorry about that. I'm a fidgeter and I touched my little thing there and it muted my microphone. Where was I?
Questions people ask you
but
about
people who are not in real estate, you can go to work and be in a bad mood when you work for somebody else and get away with it. When you're in business, you have to have the drive to get up every day and push yourself. And if you're supporting your family and supporting your business, what do you do to keep your mindset positive? What do you do to keep yourself focused on where you want to go? You come across as, every time I've seen you, you're very focused, you're very clear, you have a clear plan, you sound determined, courageous. What is it that helps you keep your mind set on those focus goals?
So the first thing in the morning, I try to get sunlight early on. So that starts my day nicely. And if it's a pouring rainy day, I still like to stand in my patio just to get outdoors and breathe rather than staring at my gadget. That really helps me get grounded. And it also helps me to think as I see nature and how big the world really is and how small we are. Let's make the most out of our short time on this planet. Is how I start the day. So I say, what is one thing I must get done before I go to bed today that's going to move the needle the most in my projects, right? So I'm in the middle of 2 refinances that I'm trying to get done before mid-April when taxes hit. So whatever I have to do each day, if anything detracts from those 2 things for me in the next 30 days, and we're talking in March, then that's going to be my focus. So similarly, from a business perspective, you have some big monumental priority that you must get done. So I'm not focusing on new acquisitions because those 2 refis are crucial. Same way, on the personal side, right? If my son has a big event today or my daughter has something going on, then that's going to be a priority. I'm going to block that time. I'm going to make sure my calendar is not booked. But the rest of it is like realizing that let's focus on what's within our control. We cannot control other people's reactions. Somebody's going to get mad. You got to tell an investor the bad news about your deal. That's okay. You still tell them and you say, here's what I'm doing to work on that, to improve that situation. And you be upfront. And it's easier to just tell the truth than to try to come up with a story and then remember the story weeks later. So it's much simpler that way. And I say, I'm doing everything that's within my control. I cannot control interest rates, unfortunately. But here's what I'm doing instead is I'm trying to refinance out of the bridge loan so that we don't have to be affected by it in the future.
I remember when I had to explain to the customer why a number of deals we had going to court for approval were delayed. And he was like yelling at me. And I said, I didn't cause the global pandemic. I'm just a real estate broker trying to help you sell the property the best I can. And I'm giving you the information.
Exactly.
The court's closed. And he stopped and started going, yeah, that makes sense. Like sometimes I can't control what I can't control. And I think like you, I just don't really worry about it. I do the best I can. And you win some and you lose some. And I guess like the Cowboys, you win more than you lose. You just don't win the Super Bowl about every 20 or 30 years or something like that. Did I just say that? That's terrible, Bill.
I moved in the 90s and we had 3 Super Bowl wins.
Exactly.
And last season was a home game against the Packers. I really thought we would win, but it didn't happen. But I'm not giving up hope.
Okay, good. Well, good for you. Always hope. Cowboy fans are always hope for next year. Well, good luck with that. So for somebody who is interested in learning more about you, obviously the reason, full disclosure, the reason why I had you on here, I don't get any affiliate income from this. I truly get asked all the time, how do I get started? How do I build my real estate investments? And I've along the way invested in some projects, but they're closed. And I just made a big investment on a property. So I'm kind of out of the market for the next until I make some extra cash to invest again, 3-6 months maybe. But I get asked all the time, and really my reason for asking you on today is to answer the question, well, where can I get started, and how can I learn about investing passively, and how can I learn about multifamily out of state? I'm in Los Angeles. So for somebody who wants to learn with you, learn from you, be around you in your organization, what's the kind of on-ramp to get more information and to get started?
So my website, engineered-capital.com, is the best place to get started. They can download my free checklist to vet a sponsorship team, and that's going to help them. And then the second place, that's my website. So one of the things you can get is you can join my investor club. You can also download the free resources there, such as vet a sponsor checklist. And I also have periodic webinars on educating passive investors. My most recent one was about taxes. I had another one previously about, how do you vet a deal, etc. So the biggest thing I would say is join me on my mailing list, watch me on LinkedIn and Facebook, post a lot of things, whichever platform you like. Schedule a call if this is the kind of investment you want to get into in the future. And then after that, I share examples of past deals. I tell them all the risks that I just outlined in this podcast, which is, hey, there's always a risk of losing money. I haven't lost my investors' money, but you never know. If a disaster strikes, there's always things that are. So this is an investment. If this is your last $50,000, don't invest, etc. That's what I tell people. So after we have repeated phone calls and we are good and we reach a level of comfort, then they get officially added into my database for future deals. Because there's a basic mailing list just for educational purposes. And then after repeated conversations, they give me permission to join my mailing list for investments.
Got it. And so, look, I really appreciate it. I also see you on podcasts from time to time and webinars and speaking and presenting. And I know you spoke at a big conference, I want to say a couple weeks ago, right? Where was that?
Raise Fest. It was mainly for syndicators who are raising capital and doing fund of funds kind of thing. It was a conference by Hunter Thompson. It was in Phoenix.
Very nice. Well, congratulations on that. And I saw some of the highlights from that. And I know I see you all the time. I try to jump in when I see you speaking because I know I learn a lot. So anybody's looking to get started in passive investing or wants to get into syndication, but learn from somebody who's done this successfully and really done a great job in her market, I would recommend check out Sandhya and go to engineered-capital.com. I'll have the link down in the description of whatever platform you're watching. Sandhya, again, thank you so much for your time, for opening up your book, so to speak, and opening up your heart to people who are helping. And I really appreciate your time as always. Thanks for being with us.
Thank you very, very much. Always a pleasure.
And actually, this is the LA County Real Estate Investors Association podcast. We do this every live on Tuesdays at 3 p.m., but it's also an association with the LA County Real Estate Investors event that's held live in Rancho Park on the second Thursday of the month. If you go to the LAREIC.com website and scroll down, we get about 200 people who come to see a presentation. We also have a vendors conference and then different speakers. So March 14th, coming up this Thursday, this recording will be on after that. We have a speaker on flipping properties, but we always have a different topic on different types of investments. We also have a vendors expo, about 50 vendors. I'm one of them. We're professionals who are in the business to help you build your real estate business. So again, thank you to Sandhya and her team. Thank you for those of you watching. I'm at Bill Gross Probate on social media. This is the LA County Real Estate Investors Association. Thank you so much for being on the call today.
Thank you. What part of LA do you live?